Joining us at Post 9 is Alger Capital Portfolio Manager Ankur Crawford. It's good to have you back. Welcome.
Good to be here.
And so Nvidia's second biggest weight in your capital appreciation fund behind Microsoft. After even just a week like this, what do? Do you leave that alone? Do you trim some?
I think when you're so early on in a paradigm shift in a compute cycle, and you own the company that's the dominant compute platform, you leave it alone for now. May it pause and rest for a few months? Sure. It's been known to do that. It's done that many times before. But as long as the numbers keep going up, the multiple will keep going up.
And you say we're so early on. How do you determine where we are in all of this?
It's really hard, but one can look, the TAM and the opportunity for AI, for Gen AI, for a time of parallel compute it's just starting. And the opportunity, I mean, Jensen has described it as $1 trillion installed base plus another $1 trillion of additional TAM in the market. So it's a very large TAM. I think it's hard for us to even imagine how big the TAM is, but it is very large.
One of the things that stood out in the print last week is their adjusted operating margin close to 70%, yeah. And a lot of conjecture about how that can stand, right? How long that can exist before another company tries to come in with some product maybe almost as good and chip away at it.
Yeah, so I think one of the things that is underappreciated is that semiconductors have spent a decade, almost 1.5 decades consolidating. And they've consolidated because it's really hard to do what they do. They have very, very deep moats. Secondly, if you look at Nvidia and the pace at which they're innovating, it is unprecedented. We used to be on a kind of a 2 to 4 year cycle. Like Intel had a tick-tock cycle. Every 2 years they had a new chip, a new architecture every 4. Nvidia's accelerated that to 1. That is incredible. So if they can stay on this innovation curve, it's going to be very hard for the rest of the market to catch them.
It looks like I'm looking at least numbers here in terms of the weighting of sort of the biggest companies. Microsoft, Nvidia, Amazon, Meta, and Apple and Alphabet comes close to 50% of your fund. You're comfortable with that? And if so, why?
Yeah, so we are in a paradigm right now where the large are actually going to take more mind share of the market. And in part because the investment that needs to be made either by the government or it needs to be made by, companies that have huge amounts of free cash flow. And they can afford to actually invest in all these. You look at what Microsoft's going to spend in CapEx, $50 billion. Google, 40 billion. Meta, $40 billion. These are big numbers.
The numbers are extraordinary. So you're in the view that essentially the biggest will continue to get bigger in part because of the advance of generative AI. They're the only ones who can actually fund it.
That's right. And so they become the platforms upon which it is built.
But how do you measure that return on investment?
So right now, I mean, we only have shreds of information on what is the ROI. If you talk to providers like Llama, what they're saying is effectively for every dollar you spend on a GPU, your return can be anywhere from $4 to $7. And that's something Jensen and his team had said on the earnings call. We're seeing paybacks of 12 to 18 months for a Gen AI data center. So the payback is there. The ROI, I believe the ROI is expressed in a different way than the market expects. The market is often focused on the productivity increases or the cost savings. And I think there's a really different way to look at it. Look at Pinterest, right? So Pinterest started deploying AI into their ad models and were able to inflect their revenue growth and their MAUs from single digit to 12%. The stock went from 30 to 40 on that report. The ROI on that is almost infinite because they didn't spend that much in order to get those kinds of results.